Hi everybody. Hi everybody, this is Dan Sheridan from Sheridan Mentoring, and today I want to just focus again a few thoughts more on some of these wild stocks that a lot of these folks from Wall Street Bets or Reddit or any of these have been trading. And more just a few things to think about. You know, I was a specialist market maker on the floor of the CBOE for over 20 years, so I was the one making the market. And just a couple things just to keep in mind. The most dangerous thing I think for trading options right now is this. Number one, you look at the implied volatility. If we just take GameStop today at $99, down $125, and when you look at, let's say, an at-the-money call, the 100 strike, two big things. A, the bid-ask is very wide, $2 wide. And, I mean, that's something, if I was a trader, I would talk to my brokerage firm about. But the bigger thing is this. With the implied volatilities at 500, you know, just take, for example, a call. The Feb 100 calls are trading at $35. The Feb 12s, there are 10 days to go. You need a break even over, you need a stock price at 135 just to break even at expiration by Feb 12. It's almost impossible. The only ones really benefiting are the market makers, of which I was one of them, in the pit. They have a wide bid ask, so they can buy on the bid, sell on the offer if there's a lot of volume. And number two, and that's it. And they're getting, and most of the time you guys are coming in with market orders. So, you know, they sell it at 35, buy it at 33 and a half. It's a wonderful thing. So I would use more, I would use more limit orders. That would be a tip. The other thing is I would talk to my brokers, whether it be Robinhood, whether it be whatever firm it is, and just say, hey, I need to trade spreads. There's no way I want to go in and buy an option. Except for, you know, a day like this, yes, you could have, I think, made some money on a put because it moves so far, but at a 500 volatility, you want to be able to do spreads. Instead of buying an at-the-money call, this would be the Feb 100s, if I'm going to buy something at $35 and I need the stock to go to 135 to break even, I want to be able to sell something against it. So if I'm bullish, let's say today it's down $125, I think GameStop, if you think GameStop will come back, buy the 100 calls and let's say sell the 120 calls. So you're buying high volatility, but you're selling higher volatility. And so a 20-point spread might cost you $6, $6 debit. So I think those are important things. I would talk to my brokers. Why can't we do spreads? You know, the market makers in the pit, it's easier for them to do spreads. They can do spreads, and then it's a tough situation for you as a retail trader to win there. So what are the two things I want you to think about? Number one, the bid-ask spread. Don't use market orders, use limit orders. Number two, talk to your broker. Hey, we need spreads. You can't expect me to go and buy a 500 volatility. That's stinking ludicrous. If you're bearish, you can buy a put spread. If you're bullish, you can buy a call spread. So again, those are some tips I hope are helpful to you. Thank you so much.